Hello and welcome. My name is Dave Engel. I am the Managing Director of Venture Capital here at AlphaCore. AlphaCore is a comprehensive wealth management firm that focuses on integrating alternative assets as well as traditional assets into our clients' portfolios. Today we are here to talk with Phil Wickham about all things venture capital. Phil has over 35 years of experience as an entrepreneur, venture capitalist, teacher, and author. Phil co-founded Sozo Ventures with offices in Redwood City and Tokyo, which currently manages over $1 billion across 4 funds. Phil was the CEO and chairman of Kauffman Fellows and serves as an adjunct faculty at Stanford. Phil, thank you for joining. Welcome.
That's great to be here. Thanks.
So Phil, I know you grew up in upstate New York. I'm guessing you did not dream of becoming a venture capitalist as a child, maybe a pro hockey player, maybe a pro baseball player, a cinematographer, something like that. Tell us, how did you get started in venture?
Well, for people in my vintage, venture was very much a black box. So I started in the mid-90s and there wasn't really a lot of information about it. There was nothing on the web about it. So I wasn't really intending to become venture capitalist. I think I had grown up in a family of teachers. I was an athlete. I loved coaching. And my startups in Japan were really focused on education, corporate education. And I learned some really interesting lessons I did 2 startups in Japan. One worked very well, one worked or didn't work at all. And I was really more interested in venture capital, not so much from, I want to go do this, because we didn't really know, no one really knew what it was, with the exception of a few people who did it. But I had seen, everyone knew the correlation, that at the top venture funds, there were amazing startups coming out of it. So I was curious about what I could learn by going inside of those firms, if I could get inside, to see how they think about the characteristics and how they coach and support the best startups. And the Kauffman Fellows program was really the only access point other than getting one of the 2 jobs that came up every year in the United States.
Right. So tell me more about the Kauffman Foundation. It sounds like there wasn't a whole lot of educational opportunities for young, emerging VCs at the time. It was kind of an old boys network, if you will. People were maybe not being educated on the best practices and what the world really meant to a venture capitalist. How did Kauffman change that, and what was your role in that? So
in the early 90s, when the Kauffman Foundation conceived a fellows program, venture capital is essentially an American industry, and it was very small, sub $5 billion a year, which is maybe a week of venture capital today. And yeah, it was a lot of it was family connections and just not a public kind of a function. And so Mr. Kauffman, who was a very successful entrepreneur who had bootstrapped his company, was a Navy veteran, was a very patriotic man. Got to learn about venture capital as he became one of the wealthiest people in the world after selling his company, and said, this is a strategic asset to the United States. We need to go in, codify what these funds are doing, and we need to then identify and develop young talent. And he gave the marching orders to his team at the foundation, which was his executive team from his company, Marion Labs, and said, go solve this. And that is what they set out to do.
That's great. Wow. And you were in the very first class at Kauffman and then became the CEO later on. That sounds like it feeds into your teaching, mentorship background. How did that actually come about, and what were some of the learnings that you took from mentoring all of these younger emerging managers as they came through the program?
I think one of the catalysts for getting that involved in the operations was I probably had a much higher level of curiosity about the program itself than my other 12 classmates, many of whom knew more about venture than I did. They were more intent on becoming venture capitalists. I wasn't opposed to it, but I was fascinated by what the foundation had done. I had been an educational entrepreneur, and I just got more involved in the day-to-day, which the foundation welcomed. And when it came time for us to spin it out, I was involved. And eventually was, like a lot of things, I was asked at one point to come in and help out and run it during a kind of an inflection point. I think the agreement was to run it for a year, and I'm running it for almost 9 years. So, but it was an exhilarating time. I took it over about 6 months before the Lehman shock. And so wasn't doing that well to begin with. So it was a good test.
Wow. And towards the end of that, you actually started your own venture capital firm, which started, I believe, with just you and your partner, Co.
Right.
And has now grown to well over $1 billion under management, 4 very successful funds. How did that come about, and what did you bring from kind of your educational experience and entrepreneurial experience to starting your own venture fund?
Sure. So the Kauffman Fellows Program is a 2-year education program, but what really is it's essentially a guild. The idea is that it's a professional network that you can leverage for the rest of your career. And so as it grew from junior people and people became more experienced and more successful, we started to see more entrepreneurs in venture capital leverage. So people that say, here's an area where entrepreneurs aren't being served. I want to start a new kind of venture fund. I want to start it in this geography or in this sector. So it's very common in the role as CEO is you would just have the fellows come in and seek advice, thinking about starting a fund. And as we grew the number of successful emerging managers, that gave us a network to say, well, okay, go talk to Mary, go talk to Fred. This person will help you. That person will help you. My partner, Ko, was Japanese, was the one that came in and said, I want to do something cross-border in Japan. I had done that in a previous firm at Jafco. I had some experience on the ground in Japan. And I got more involved than usual. And eventually it became essentially my succession plan out of Sozo. So I did that. I overlapped for about 3 or 4 years while I was still running the Fellows Program. And when it got too big, I handed off the Fellows Program to someone I had been grooming.
Right. Wow. And I know you've been very successful at Sozo. I've seen the people that you've put together. It's a great team. But I think what a lot of people would like to know is, during that transition, how did you find kind of the investments and the companies that you really wanted to back, that you saw the passion in? What was kind of the selection criteria? And is there 1 or 2 things that you feel like really set those very successful entrepreneurs apart from the ones who maybe didn't do as well?
Sure. I mean, I'll want to be careful of the language here. I would argue that our business is about 5% selection and about 95% sales. So it's not that hard to figure out a very, very talented entrepreneur. And the later it goes, the easier it is. Any fund that starts out as a no-name better start out with a real product strategy, with a real service strategy. Right. It can't just be a charming set of people with a checkbook. It's just not enough to compete. So our approach was we basically had a network of Japanese corporations that wanted to access the flows and trends of cutting edge startups, but they had no idea how. And on the other end, and this was where the Kauffman network really helped, there were all these great startups that really want to get into the Japanese market. It's big, it's high margin, it's loyal, it validates you across Asia, but super hard to figure out. So we just put ourselves in the middle and basically tried to help them figure each other out. And so a lot of that was in sense of like winning a deal would be approaching a company. For example, the first investment we made was Twitter, who's approaching Twitter with an idea of how to do a set of corporate partnerships in consumer data, which they had never done before. It's very successful. It got us the attention of management. It eventually got us access to an SPV and a secondary, and we were able to raise the money and make that investment, and that was the launch. So we really launched this platform of what is now about 70 companies with just a single investment. Wow. Which is a very, very smart way to start a venture fund is just do one deal. Right. Start a rock band, don't write 30 songs, like try to figure out one great song. Yeah. And then from there you can move on. Yeah, right. And nobody at the time was doing anything like this, especially in the Asian markets? In the moment, this was 2009, 2010, as we were conceiving of this, I had been in a big Japanese-focused fund in the mid-'90s, and after my Kauffman Fellowship. And Japan was always on people's radar screen, but it in the venture world, which can get very, can become very trendy, and you can get a lemming effect. Certain geographies become favorable and certain fall out of favor. In 2009, 2010, to a person, everyone told us, don't do this. Japan has no value. Go to China. And I was like, well, everybody's going to China. I don't really get China. Co and I know Japan. Right. So we believe in Japan. If no one else wants to do this at the time, I don't think really anybody was doing it.
Yeah.
And that was a great advantage to us. Now, what's really funny is today, Japan is the most fashionable place. Everybody's running to Japan.
Yeah.
But if you actually look at it in those 14, 15 years, nothing's really changed.
Right.
But it's just funny how things become fashionable. So for us, we just stick to our knitting and I think our early dedication and our track record there sets us apart.
Yeah. There had to be some hard lessons when you first started. Anything that you feel like maybe you would have done differently given the information now? Anything that you feel like you really learned from in those early days starting your own firm?
Oh, yeah. I say this to my students. I say it to young people all the time. I'm 61 now. I think of this world of innovation. The difference between industry and innovation is industry is kind of historical and rules-based. And if you're in innovation, you're essentially inventing the future. So you're experimenting, you're constantly figuring out what the right question to ask is, not what the answer is. The more you study this business, the more you do it, the more experience you get. I was equated to like space travel. You can get out to the moon, you can get out to Mars, and you may know more than any other human because of that experience, but you also understand the vastness of space much better. So it's a very humbling experience. Yeah. So I think the fundamental lesson is I wish I was a lot more curious and a lot more open-minded, and a lot less of a pretender, as I think is an epidemic of young people in venture. And as you see young people, they look like they know everything, and you meet somebody who's 70 who's world class, and they're the most curious, humble people in the world.
Yeah. That really surprises me. You're one of the most curious people I know. I mean, with the book reading and the new skills you take on every year, that's a little bit surprising. But I think that's probably good advice for just about anybody. 20 years past your start date, right? You start to learn that you should have asked more questions, right? Versus having all the answers.
So the second part of that question is the plethora of things that I have done that I wish I didn't do.
Yeah.
But you learn, I think what you do learn as you get older is how to simplify, how to focus on where the signal typically lies in a company. And it may seem simple, but don't get distracted by technologies. Don't get distracted by market research. Look at the leadership. Look at how they're designing the business model, because the business model design will tell you their level of dedication to customer delight. And so you don't really have to think about market, because if they're focused on customer delight, the market takes care of itself. It usually doesn't sit there waiting for somebody to take it. The entrepreneur it's kind of halfway there.
Okay.
Great entrepreneurs move it.
Get it all the way.
Right. So you're looking at how they think about the business, and to borrow a phrase from an amazing investor, Ann Mira Ko at Floodgate, heard her say this at a talk, this idea of a super builder, somebody who is obsessed with building the thing that the customer wants, not getting fascinated with their own toy. So they're throwing features and ideas away as fast as possible to keep shaping it. And that's a very egoless approach to doing a startup. And these are things that stand out once you know to look for them.
Yeah. I think we've both seen in our careers tech founders who are extremely enamored with their own product, and will even say things like, I don't need a sales team, this will sell itself, right? That very rarely works.
Run away
as fast as you can. And you said something interesting to me last night around what you look for in those type of founders, not only the builder mentality, but would you as a person want to work for them? Would you as a person want to run through a brick wall for them, right? Those are the type of people that you look for to get that signal in the marketplace.
Yeah, I think that one of the secrets to the business in making a decision is understanding your own emotional intelligence. And there's a couple basic ways that you can test that when you're looking at a company. That came up when a young person in my firm asked me, like, how do you know past the quantitative analysis, which you can do until you're blue in the face.
Yeah.
But it's not enough. And so you do have to test those things of like, do I have such a pull that, I love my job here at Sozo, but I would actually quit to go join this person?
Yeah.
Well, that's an indicator of their ability to recruit. Will their customers follow them? Will their partners follow them? That ability to create a narrative and align really smart group of people around that in an area. That's the essence of a leader.
Yep.
And if you think about a startup, oftentimes really the only thing you can hang your hat on is the future narrative.
Yeah.
They've got whatever they have today, but what you're really excited about is what they're going to try to build in 5 years.
Right.
So those sorts of things, and the running through the brick wall is just a higher level. The other thing that I think is a very interesting exercise I do with young people in the firm, and I teach this at Stanford as well, is just doing a simple 2x2 decision matrix, where on the y-axis it's we don't do the deal, we do the deal. On the x-axis, it's not a good deal, it is a good deal.
Okay.
And from a decision standpoint, you can just cross out the bad deal you pass on and the good deal you do. You don't have to think about that.
Yep.
But you have to play around with the scenarios of how do I feel if I pass on this deal and it becomes a really big hit? Mm-hmm. How do I feel if I do this deal and it fails? And that's a really interesting dividing line for investors. And you will be forced to look at something and say, I really like these guys. I hope they do well. Something about it I'm not that bought in. I would, I'd regret it if I didn't do it, but I'd be okay.
Yeah.
And I'd really feel stupid if I did it and fail. And then there are the deals where you just say, this happened with us in our first deal in the fund after Twitter with Square, did this with Co. And it was a very interesting company because we knew them for 2 years. We worked with them for 2 years before we invested. We knew the co-investors. We knew how good this company was. And they were just getting trashed in the media. And so we're looking at this as the first investment in our first fund.
Yeah.
And it was scary. And I asked Co, what do you want to do? You want to pass on this thing?
Yeah.
And he, he thought about it. He said, no way. I won't be able to live with myself. This is a great company.
Yep.
And so we went ahead and did it. Wow. We got a lot of criticism from our LPs. Like, this is a really small, weak company. Yeah. No, it's not.
Yeah.
This is a totally different company than the media is portraying it. And it turned out to be a smart move.
Wow. Yeah. That's great.
And it was, like, for me, it was helpful because he knew the company better than I did.
Right.
And so I knew how smart he was. And that forced him to get beyond the analysis. I was like, okay, I feel really good about this.
Yeah. And I think if you could, like you said earlier, if you can see beyond what they're doing today and what the vision is for the future, right? That's always a huge indicator if they can actually communicate that to you, right? I've worked at a few companies where we didn't have the best product, we didn't have the best technology, but we had a vision, and that vision was able to be communicated to customers, suppliers, partners, all of that, right? And those companies did extremely well. So I think that's a big piece of it.
I mean, we all know this from people that we work with, partners, employees, whatever. If you have a brilliant visionary person who's very ethical and very committed, they get a couple swings at it.
Right.
And it's the same with a startup. Your Reid Hoffman has a famous saying from Greylock and LinkedIn is your first version of your product should embarrass you. And I think Reid's point is, like, you're not trying to be embarrassed, but don't sit around and breathe your own fumes and perfect this thing. Get it out to people who care about you and get feedback on your product, and that can then modify. It comes back to the super builder thing and the willingness to say, I'm not married to this concept. I'm married to the delight of the people that I want to sell this to.
Right. Yep. So, Phil, I've seen you talk a lot at conferences, at Stanford, at private events, and one of your big themes is demystifying this space of venture capital, right? When I first got into it over 10 years ago, mostly because of you, I had a hard time outside of you understanding how the entire industry worked. Getting information in and out was extremely hard. It was a very closed network. So can you kind of explain a little bit about why it's such a mystery asset class and what you think people should know about it?
Yeah, well, I think at a high level, and you could see this in pop media, this glamorization of a lot of different careers, whether it's a hospital drama, LA Law, The West Wing, anything you look at in Hollywood, these jobs that are more in the public eye look very glamorous and very romantic. And anybody that is in those jobs will tell you it's a real grind, and it takes a long, long time to get real things done. So you start there, and I think anyone who looks at a startup or venture capital as something that's glamorous is similarly misinformed.
Right.
So I think if I step back, and I'll commonly get this from students, or especially students, they'll say, like, what's the difference if I want to be an entrepreneur versus a venture capitalist? And both are incredibly hard. They're incredibly hard jobs because they're both about inventing the future. And that's just a more uncertain place to be, and uncertainty scares humans. The difference is, in the startup, you have a ton of immediate short-term pressure this week on features, on sales, this month, this quarter. And in venture, we don't have that. Like, we might get some pressure in a year, but you're really looking at it in bites of more like 4 to 5 years where you really start to see some results. And really, it's 10 to 12 years for a fund, right? Now, that is great if you are comfortable in a world where you get absolutely no feedback. The nice thing about a startup is at least you know this week or this month or this quarter whether you're on track or not, right? So I sometimes tell the students, like, imagine you went to college for 4 years and you took a bunch of tests and did a bunch of homework, but you never got any grades. And then you show up at graduation and you might graduate, but you might not.
Right.
And if you're comfortable and you have that much confidence in yourself, that's kind of what it's like to be in venture. So when you look at it, you're in a typical fund, like our funds might have 25 to 30 investments, and they're made over the period of 4 years. And they're sometimes at different stages. We're not super focused on early stage. But you're looking at that portfolio, and you want to make sure that you achieve some balance, that you're not doing things too late in the investment period because they'll extend really long. Right. So you've got to balance that, and then you're raising a new fund every 4 years, and you have to balance that capability. So you're always investing and you're always harvesting. Right. You might have typically 3 funds active at the same time, and then you have a management company that oversees that. So from a venture standpoint, it's actually a fairly complex operation that a lot of people don't understand. They think it's Shark Tank. For 10 companies line up in front of you. Not quite Shark Tank. It's generally a pretty good group of people because it's such a long-term relationship business. There's not a lot of sharks in venture. They don't last very long if they are. It's a very committed group of people, but it's that temperament of being able to do things and believe in yourself for 5, 6, 7 years is rare.
Right. I had somebody describe it to me the other day as, when you enter into a venture capital fund or start a fund in a firm, right? It's not a 2 to 3 year commitment. It's a 10, 12, 15-year commitment. It's more like a marriage than it is a partnership, right? You have to really pick the people that you want to go into that business with well. And like you said, the sharks just don't last very long.
Yeah, I generally agree with that. I would say, depending if you're talking to a young person who wants a couple years of experience before business school, it's a 2 or 3 year bite. If you're a partner, I'd actually say it's more than that, because generally investors, the LPs, are going to invest in you with the expectation they can do 3 funds.
Okay.
And so those funds are going to come every 3 to 4 years. And a 10-year fund, I think the average life is 14 years. There's a lot of extensions. I finished the portfolio. So you're looking at least a 20, 25-year commitment. And so this is something that's very hard for young people. If you're 32 and you're looking at a major partnership opportunity, you're kind of committing into your 50s. And one of the things you're fairly certain of when you're 32 is that you're never going to be 50.
I thought that for a long time, even after it was 50.
They have to sit there and they say, "Are you really thinking about this?" Because as a venture capitalist, whether you're here or somewhere else, everyone you meet, LPs and the fellow GPs you syndicate with, everything that you do is based on your reputation. And so if you commit to something, it's hard to uncommit. If you're a junior partner and you aren't given the opportunity to really sort of sink your teeth into the management and the carried interest, well, then it's quite acceptable for you to move on. But once you commit, closer to one of the key people in the fund, it's very hard to leave.
Right. So I want to talk a little bit about the J curve, the power law, all of the things you hear around venture capital investing, right? And you had a good analogy around, we go to the 100 best basketball players in high school right now, right? And how many were actually going to make it? So power law kind of describes that a little bit in the venture capital world and how to invest. How do you feel about that? And is there a way to either increase your odds, or is this a multiples business where, 3 out of 100 is good? What can you kind of describe that for us?
Well, if you look at the correlation, so one of the things that's interesting about the power law is that it in terms of remuneration or awards, it replicates itself in all walks of life. You can see it in, you can see it in professional sports in terms of pay. You can see it in terms of, Tony Awards or the Academy Awards. I think John Williams has like 5% of all the nominations. I think it's 53 nominations. So it reoccurs again and again and again. So left to a giant sample set, you're going to see typically about 0.5% of the startups really ring the bell. And for us, ringing the bell is 100x return, which is a real fun maker.
Right.
And you're hoping that any investment you make in a portfolio that most of the companies have a shot at a 20x return. Once you get a 20 to 25x, you've returned the fund and now you have some leverage to work with.
Okay.
So like anything else, the way that I think you differentiate yourself is, are you able to pick up signal that other groups cannot pick up? Right. And so that signal can be in part your particular product or service that you run against them. So for us, we'll see a company has traction, it's in the US. We'll throw it up against 5 or 10 major global corporations that happen to be Japanese. So you get a global market feedback on them, but you're also running them through Japanese scrutiny, which is brutal. And if that sticks, we're like, oh, this is interesting signal, and everything else looks good. We'll play with that. We even see a lot of other funds have those same kinds of advantages.
Right.
What is it that you're looking at? Sometimes it's just some people have a sense of greatness in others that is, non-qualifiable, but you've got to have something that allows you to get in front of more high quality companies and something that allows you to test them and also to win them.
Okay.
So when I look at emerging managers, that's the test I'm running on the founders is, do they have the ability to think that way? Do they have a differentiation? Are they systematic?
Right.
Does that system, is it sustainable? Is it compounding? Those are the questions that I ask when I look at venture funds.
Right. And would it be fair to say that much like looking at a portfolio of startups that you would invest in, if you were investing in venture capital as an asset class, you probably wouldn't just pick one or two managers. You'd want to kind of spread out that multiplier effect to multiple ones so that you can capture as many upside possibilities as possible while limiting your downside.
Yeah, I think whether you're designing a portfolio of startups or you back off to the LP level and design a portfolio of GPs and funds, you're confronting the fundamental question you confront is concentration, right? So what is the number that makes sense where you've got enough diversification,
right?
But you've got enough concentration that if you win big. So yeah, that's you don't, I think that if you're thinking of it as an investor and you're picking one venture fund, you better really know what you're doing.
Right.
And there are 10 LPs in the world that are extraordinarily good at picking emerging managers. And if you're in that fund and they aren't, then you have to ask yourself, how did I get so lucky?
Right.
Chances are you're not lucky.
Right. That's a good point. So Phil, you've seen many cycles in your 30-plus year career of venture capital. There's always the ups and downs with the economic climate, with what is hot, what industry, AI today, biotech 3 years ago, whatever it is. How do you feel about where we are today in the venture industry, and where do you see us going over the next 5-6 years?
Well, it might seem counterintuitive, but I think most of the experts, and I would agree with this, is that we're in the midst of what's going to be a few vintages of very high performance. And there's a couple reasons why that is. First of all, we were in a bubble, in this zero interest rate bubble, a lot of money coming in, and a lot of, we call weekend warriors starting companies because it looked like a quick buck. When that turns upside down, everybody runs. The late stage, less intelligent money in a lot of those startups. But in the startup world, the entrepreneurs who are destined to build great companies, they don't even know what's going on in the economy. They don't pay attention because they're too obsessed with their customer. They might not know in a given year where the stock market went up or down. That's not uncommon. And so for us, And I think for people who see this cycle, it's fantastic because there's less competition. Again, coming back to 95% of our business is sales. So we have a lot less competition, which gives us more time. For us, time is really important because we can do some really interesting business development and work with them in Asia leading up to an investment opportunity. So we more time, better decisions, lower pricing.
Right.
And you do that systematically across a portfolio. Quality of companies is no different. You're just paying a different price and you're probably having an improved level of quality. And that's why I think the best funds have better performance in these vintages. It has a lot to do with people basically conflating a stock market moment with where venture is, and it's just they're actually two very separate.
Yeah. Yep. Yeah, I saw a report the other day from Stepstone, and it talked about that power law for vintages, and it said basically you need to spread allocations very consistently across vintages within venture capital specifically, and you just never know which ones are going to be the absolute outliers, right? And we can try to predict it, but if you have put that money into play over time, right, you will hit one of those vintages was basically the message, and not to try to time it, but to try to time it, right? So to be consistent in this class, to spread out your risk while maximizing your potential return, right? That was kind of the thesis of the report, and I think it's just a thing that a lot of individuals don't really do, but a lot of institutions and endowments do really well, right? So in kind of your as a general partner, when you talk to LPs, how do you kind of describe, hey, it's not really a timing issue. It's more of a, we've proven that we can find signal through the noise in our selection. How do you communicate that to LPs that might be an individual, it might be an endowment, it might be an institution? How do you kind of phrase that?
As far as for us or any fund?
For you. I mean, I think, just specific to you, because you have a very widespread LP base, right?
Sure.
And a little different than maybe most American companies.
Sure. I think we begin and end every conversation with our LPs with the word system. And I think if you look at any institution that performs consistently, you're going to see they have really well thought out systems, and they have a lot of leadership stability, and they take development of talent very seriously. That's primarily what we communicate to them. And the reason that's important is that ours is a business of getting in front of the best entrepreneurs, which is not easy.
Yep.
And then having something to say when you do. Right. And so everything you do that's everything you do that's systematic and of high quality is a branding event. It's reputational. And so oftentimes it is one extraordinary entrepreneur introducing his friend to say, I really liked how I was treated by this team.
Right.
I liked what they did for me, whatever it may be, or a GP that you're on a board with. But it's looking at every interaction as a branding opportunity, as an opportunity to network. And to have that, you have to think like a system. So that's the most important thing. And because it's a long-term business, you've got to show stability.
Right.
And so if you're investing in a team that's been around for a while, there's a lot of evidence of stability.
Yeah.
If you're looking at younger people and they're trying to do something new, it's fairly easy to go into their background and say, do they think of their interactions professionally as part of a large system, or are they jumping from transactional job to transactional job? If I see that in their background, that worries me.
Okay.
Right. But if you see people that, they can go back to, they're 35 and they can go back to an internship when they were 19 and they still have a relationship with that mentor, and they're still doing things, and that mentor will call with an enthusiastic recommendation.
Right.
You pay attention to those sorts of things.
Right.
It may not seem like the biggest deal for most jobs, but in our world, it is so important.
Right. Yeah. That's great. So on that note with systems, I'm assuming it's a similar answer, but going to ask the question, how do you feel about chasing trends, right? I mean, right now all we're hearing about is AI, machine learning, all of these great little acronyms. 15 years ago it was SaaS, blockchain, crypto, all that good stuff. How do you feel about venture's role in promoting those types of industries, but also as a allocator in how you invest. Do you chase those? Do you try to understand them, or do you look longer term?
So it comes back to this concept of at least a belief system that the differentiation for a startup is business model, and it's not technology in and of itself. Now, technologies can impact a business model. So people, Uber, everybody knows Uber, and they think Uber is a ride-sharing business. It's actually an internet business. If you look at how you make the request, how you process, how you map, how you pay, all of that's enabled by the internet, but nobody talks about that. The internet company we talked about was Netscape, because that was the first time we could visualize TCP/IP.
Yep.
But TCP/IP's been there since, I think, the 50s.
Yeah, right.
Military applications. So now we have this with our LPs. They're coming back going, AI. We're like, Palantir, Grammarly, Chorus. We have all these deals we've been doing for a dozen years that employ AI, but it's not visible.
Right.
Now with OpenAI, people can type it in and go, oh, AI.
Yeah, right.
Now we did a letter for our LPs where I had one of the guys on my team go back and research the first academic paper on machine learning, which is the basis of AI. And it's from the 40s. I mean, this has been around for a long time.
Right.
So, you could look at Google and say, well, Google's an internet company. It's a search company. Well, it was word search that made their business model work. And search is a form of machine learning. So you could argue Google's first enabling technology was closer to AI. The internet was the core. Right. But without the AI, there's no business model. Right. And otherwise, you just have people randomly searching and no one's paying for anything.
Right.
Word search, and now you have an advertising revenue thing. So for us, the way we think about our approach strategically is we like the way data can disrupt traditional industries. So is that a trend? It's more looking at what can be radically improved by data analysis, by AI. And we've just been drawn back a little bit. One of the things I love, I think maybe the smartest person I've ever met in venture is Bill Gurley from Benchmark. And anytime you ask Bill, like, what's the future of venture? And he generally says, I don't think I'm smart enough to do that. I rely on the great entrepreneurs to show me the future. So we're not sitting there trying to predict the future, but where the entrepreneurs have been showing us in the last few years of where data is really disrupting is things like disease management, especially age-related disease management. Very interesting for us because of the demographics of Japan. Sustainability, clean tech, food. There's some really interesting things happening there.
Yeah.
So we'll continue to do that, but it's all AI really does is it gives us another tool in the bag to manipulate the business model. So we're going to see business models like Uber that are enabled because of AI coming into the mix.
Right.
Same thing with blockchain, especially, people are big believers in blockchain is going to change the international money exchange business quite a bit. It's certainly very broken. So, but it's not, it's not necessarily about crypto coins. It's about the underlying blockchain, the single ledger, and what you can do with that you couldn't do with a bunch of disparate databases and spreadsheets that couldn't be synchronized.
Right.
So that's those entrepreneurs that are thinking about that. I think blockchain has not found its really big idea yet.
Right.
AI, I think, has found a bunch, and we have a lot that we really like.
Right. Yeah, that's great. So on that subject of cycles and what the future holds, I think every cycle in venture we've seen, the name brands out there, everybody knows who they are. But every cycle seems to create a new kind of emerging manager who grows into something that is its own system, right? And it kind of changes the game a little bit. The common term for those folks are emerging managers. And I feel like emerging managers are even maybe harder to understand and pick than the name brands, because you have to really do the research. You have to find the signal through the noise with these hundreds, if not thousands, of new firms every year. How do you view that, and what do you think changes an emerging manager in a cycle to something that becomes almost too big and unfocused? How do you kind of view through that lens?
So there's a couple things there. I think that one of the common trends in our or a challenge for successful emerging managers is, can they stay disciplined to what brought them there? And fees are very seductive, and growing your firm to get more fees is very seductive, but that changes your business. So we see that some firms stay very disciplined, they stay small. Many grow, become very large. And so that's really interesting because it creates space for new funds to come in and do what they used to do. So if you're managing $1 billion fund, you can no longer write $1 million seed checks. It just doesn't work at all, right? You're under pressure to write 20 to 50 million, maybe $100 million checks sometimes. So that space is created, and an emerging manager is just an entrepreneur. They just are starting a money management firm, not a software firm or a tech firm. So they're starting in, and they're entrepreneurial venture capitalists who see that and they move on it. I don't know that it's necessarily easy to be assured that a proven name is going to perform just because it's a proven name. There's only about 40% persistence, vintage to vintage for top quartile funds. So more than half fall out of that, right? It's like the old joke in advertising, half falls out. We just don't know which half is going to fall.
Great.
I think there's an argument to be made that emerging managers have challenges, they're unknown, but they have some advantages that aren't really appreciated. Part of it might be the freshness of their thinking. It's oftentimes young people who spin out of good funds. It's also something that can't be underestimated is that if you have the ability to raise an emerging manager fund, back to the reputation piece, you're very well liked. A lot of people have to like you. A lot of powerful GPs have to go to bat for you to get your LPs over the line. You probably have a lot of friends in the GP world. And so what ends up happening is you'll see a really nice deal flow early on because people want you to be successful. They want you to be part of the business. So understanding someone's brand and reputation in the whole ecosystem as an emerging manager is critically important. And so I don't think betting on an established fund versus an emerging manager is necessarily easy. There's one or two no-brainer funds in the world. I don't think I need to name names, but the rest of them, it's not that clear.
Yeah, right. So one question I get asked a lot is, why be in venture at all? Right? It's fairly illiquid, fairly risky. It's driven by power law, J curve, that kind of thing. A lot of money chasing very few quality deals is what some people would say. What's your answer to that? How would you kind of phrase what the future of venture is and why somebody should allocate to it?
Yeah. Well, I'm pretty biased. I mean, I think I like the business. I think you can look at the metrics of the top 10 up to the top quartile, top 10%, top quartile of funds, and the performance is an outlier relative to anything else. It's the alpha if you can do that. It's always funny when you hear too much money chasing too few deals. That's what all the venture capitalists say. And you ask the entrepreneurs, they'll say, there's just not enough money.
Right.
And so the goal is, how do you connect the really high quality capital to really high quality entrepreneurs? What I think is really interesting about venture is it's hard to say how big it is. We kind of knew it was 5 billion-ish in the mid 90s. It's probably about $500 billion today. And people are saying, where is that going to go? How does that get bigger? I still think that's one way to look at it is it's still a small fraction of global GDP.
Right.
And we're learning that more and more R&D works better in an open environment than necessarily does in a walled garden of a corporate lab.
Yep.
So I wouldn't be surprised if this could grow another 10x. And what I think people don't really think about with venture is, if I go back to when I was doing venture in the 90s, I wonder what it looked like in the 80s, but the things we were working on were so simple. And they were little attached devices for storage, little attached devices to read business cards, like little, very simple software applications. Coming back to where innovation is going to go is that business models are basically the combination of a lot of different technology platforms. So every time we add a platform, that creates an enabler. And I think we don't really yet appreciate how much inefficiency in the economy and in society can be addressed by technology innovation. I don't think we've even scratched the surface. And obviously things like space are happening and what's happening with food. So I think we're still at the front end of the curve of where venture is. So I think to be in venture, I think you have to buy emotionally into wanting to be a part of that. If you make smart decisions about how you enter the business, you can also get really nice alpha.
Right.
I don't think you can do it with one or the other. You've got to know what you're getting yourself into.
Yeah.
But if you do that, it's just a very exciting place to be, whether you're an entrepreneur, whether you're a venture capitalist, whether you're an LP.
Right.
Because you're going to immerse yourself in the world and basically open up to these remarkable people who truly are inventing the future.
Right. Yeah, I listened to a podcast. It's a little bit old, but it's by the guys behind Freakonomics. And the title of it is Venture Capital, the Secret Sauce to the American Economy. And I went through it pretty in detail. It's very good. But
Jeff Bezos just talked about this 2 weeks ago.
Oh, really?
Yeah.
I got to listen to that.
A differentiator in the American economy.
And you gave the story about Ewing Kauffman, and he came late to the venture capital world, but
he never came.
He never got there.
He never came.
He wanted
That's the whole point.
Yeah.
He was like, I wish I had this. I wish I had done this. Now you guys better
go figure it out. Right. Yeah. But that's the conversation I have with a lot of people. Right? I've been on every side of this. I've been an entrepreneur. I've worked for venture-backed companies. I've worked for public companies. I've been a venture capitalist. I've been an angel investor. I've been an advisor. And I will tell you that without this system of investing, patient capital that doesn't need to be returned on a quarterly basis, right, and have a public market for it, has probably grown our economy and most of our great companies that other countries just don't have access to that type of patient capital, right? If you look at it right now, I think it's just 8 out of the top 10 U.S. companies by market cap were all venture-backed, right? And one of the ones that wasn't was Berkshire Hathaway, which is basically a venture roll-up company. I think when I get asked that question, I try to point to why we are so innovative and what that innovation drives in America, the job growth, the economic stability, right? And keeping us ahead of the curve. We don't want to just be a manufacturing country that takes other people's ideas and builds them, right? We want to be at that value chain at the very top end. And that's what venture capital, I feel, puts us ahead of just about every other country.
Yeah. I think it's impossible to, I think nearly impossible to argue with that. And again, also the flip side of that is it's a romanticization of what happens under the surface and all of the experiments. I don't want to call it carnage because some people call it carnage and failure. I think it's experiments. Right? So this is something that's important to understand because I run into this a lot overseas because I'm in a lot of environments where people are talking about this. And you'll hear someone who spent a couple of years in venture and they're at their home country, wherever. And they say to young people, you have to understand the difference between Silicon Valley and here is venture capitalists like it when you fail in Silicon Valley. And I have to raise my hand and say, hang on just a second. That's not true.
Yeah.
We like it when you succeed.
Yeah.
But if you run the experiment with character and you work really, really hard, and maybe you were a little early, or maybe you got out-competed by somebody, you were just under-resourced, whatever it is.
Right.
But if you played the game the right way, you'll get another shot. But there's a point, like you can probably get a few shots depending on how you do it.
Yeah.
But we're in the game. Like what makes venture work and what makes it very rational for people is if you have a distribution of companies of which 0.5% are going to go 100x, and some of these companies are, in our investment in Coinbase, we made over 100x. The investors before us made over 1,000x. If you have some methodology, a set of networks, and a way to pick up signal, it doesn't take much signal for those numbers to start to make sense, right? And so you're looking at it as a very rational thing to do.
Yeah.
I think the challenge is that a lot of people who come into the venture business, they think about it very transactionally. They think the investment is the win.
Right.
The investment is, we kind of joke like, the investment is like the wedding planner and the doing the investment is like the wedding planner.
Okay.
Being in the investment is like the marriage counselor. And, we also tell the joke that, it's 10 years to IPO, 14 years to like stability as a public company,
Right.
which is exactly twice as long as the average American marriage. So you want to enter into these things with that understanding.
Right.
And in the same way you would commit to that kind of relationship, you need to know what you're getting into. So it's just a lot of romantic misnomers, I think.
Yeah.
You get under the covers, it's actually a fairly straightforward business strategically.
Right.
It's just extremely difficult to execute.
Yep.
Like I think like anything else.
Right.
So you just have to know the game that you're playing.
Right. I agree with that romanticization, both on the entrepreneurial side and on the investing side. There was a great book written probably 2 decades ago called The Messy Middle, and it's all about, everybody hears the story of HP starting in a garage, and then they hear about the story of HP going public. Yeah. But that ugliness in the middle and the grit that it takes and the capital that had to be deployed that didn't need it wasn't a banknote with a cliff, right? So all of that messy middle in investing and starting a company, I think we are better positioned to actually handle that than any other financial system in the world.
Well, it's the first book I wrote for the Japanese market, and the goal of demystifying this was exactly that. So I taught about 35 of the world's best venture capitalists. And the requirement in each of their chapter was to tell us a story that was messy in the middle. And this is public knowledge. So Andrew Bracci at Excel, who's an extraordinary investor, told us the story of Slack. And most people don't know that Slack started as a gaming platform.
Yep.
It failed. And there was a discussion around the board of pulling maybe 60% of the money that was still on the balance sheet out, paying out 60 cents on the dollar.
Yeah.
And Andrew and Stuart, the CEO, said, we think there's something in this messaging thing we've built so the gamers can talk to each other.
Right.
Subsequently, multi-billion-dollar return.
Yeah.
It takes a lot of courage, though,
Yeah.
to do that. And those, the best deals I think any of us ever do are the ones that do get very messy.
Right.
And you see these entrepreneurs persevere.
Yeah.
And maybe they don't always put the number up that you want, but wow, it's really gratifying to be a part of that and to see them succeed and maybe make enough money to, secure their future and pay for the kids' college and, maybe pay for the grandkids' college. Like that's what this business is really about. And sometimes when you get really lucky, oftentimes you just it just happens and you just don't touch it, don't break it, but most of the time you're in there trying to work entrepreneurs through what is essentially a constant state of workout.
Right. So. Yeah, absolutely. Well, Phil, I could talk to you all day, and I actually have in the past. But for today, I really appreciate your time. This has been eye-opening for me, and I hope for everybody watching. In closing, is there anything you would recommend as far as people who want to learn more about this asset class, more about venture, podcasts, books, anything like that you find interesting?
Yeah, I think there are several things you could look at. I would go to the people that I think that are understand the business and think about it most clearly. I think 2 of the people that, if you're relatively new to venture, I would look at Thomas Tungus from Theory Ventures, who was formerly at Redpoint. I think one of the clearest thinkers. He's been blogging for a decade and in small bite blogs, very simple. I think if you studied a few hundred of them in a couple hours, and you'd have a wonderful takeaway of the business. I think Bill Gurley, again, among the crowd, is been like the standard bearer of someone who can really explain how the business works. And Bill's extraordinarily well read, and has really interesting views. There's several podcasts that I think you can listen to. I don't listen to venture podcasts too much. I have
Too exciting for you?
It's too close to home.
Yeah, it's that heart racing.
Yeah, I mean, but there are several there. I think there are also some kind of books that are non sequiturs that I think are some of the best venture books ever written. The one, Stephen Ambrose, Undaunted Courage, Lewis and Clark, it's a phenomenal venture capital book. Lewis and Clark as entrepreneurs, Thomas Jefferson as the venture capitalist, and particularly the section on how they select their team. Yes, extraordinary. Yeah. I've always liked Moneyball as a way of thinking about talent that's different. It's no longer fashionable. I was a catcher, so I was always, pushing Moneyball before it was hip. And
you were a light hitting catcher who Took a lot of walks.
Not a very good catcher, but Joe. No, I think I know what I'm talking about. As I identify with Bull Durham. I think that you can poke around pretty easily, but I really just think you find the people who resonate with you, and I think the blogs are the best.
That's awesome. Great. Well, thank you so much for your time. It's been an absolute pleasure.
Yeah, they're really fun.
Thanks, Bill.
Okay, thanks.